Welcome back, everyone. Well, we just closed on my second rental property, second and third unit, as it is a duplex. And in this video, I want to break down the deal. I just go to the basic bare bones structure of the deal, how I financed the deal, how I came across it. We'll save all the figures and numbers and cash on cash return for a future video. Just this one, I want to talk about the basics. It's quite cold out here, so we'll talk about it in my studio. I'll see you there. But before we do get there, as always, if you have been enjoying my content, make sure you give this video a tremendous thumbs up, smash that like button. I would appreciate that. If you haven't already, make sure you are subscribed to this channel, click that big red button and have notifications turned on. And with that being said, let's get started and dive right in. Welcome back, everyone. So like I said, we're just going to be going over the basics of this deal, the bare bones. We'll save all the numbers and figures for later on when both units are rented out and we can actually look at the return on investment, the cash on cash return. But you already know one of the figures of this deal from the title of this video, and that is the biggest one, the main one. It is the purchase price of the property, which was $587,000, 587K. But you do need some context here. I didn't just buy this property on a whim. I didn't always have my sights set on this particular piece of property from the get-go. Let's flash back, give you some context to 2021. So I bought that single unit, that single family residence, which I closed on in June. And we've covered that property a few times on this channel. You can see some video links down below in the description. I talk about how I bought it, the steps that I took, as well as the numbers on it and how much I make on it. And yes, it is still cash flowing. And we recently just renewed that lease, so it will continue to cash flow for me. So here's some backstory. I knew that for my second deal, for my second property, I wanted to go bigger and upgrade to a 2-unit at least, to a duplex. And so I had found something in a red hot market in Suffolk County on Long Island, red hot, booming, and it was in not so good condition. It needed some work, needed some rehab, but I knew that I had enough of the down payment for 25% down, which is what you have to put down on a conventional loan for a duplex. And I knew I had enough cash left over that even if I had to put a ton of work into this, it would be worth it and I would have the resources to do so. And I could potentially increase the value of this property at least another 10, 20, maybe even 30%. So I had put in an offer in July of 2021. That offer was accepted. Then we inspected the property. And yes, I knew it needed a lot of renovation, a lot of updating, but I was ready for it. I had the resources and funds available to do so. I even increased my credit limits a bit in preparation. And yes, the contract was signed by myself. We were just waiting for the seller's signature. And then a week goes by, 2 weeks go by, and unfortunately, the seller just decided to drop the whole deal. They were out of the country and just said, we don't want to do it anymore. Now, we believe it had to do with the fact that tenants were in place, and upon the contract, it was requested that the property be delivered vacant, and especially during those precarious times when the eviction moratorium looked like it had no end in sight. Unfortunately, the seller probably couldn't just deliver on their promise, and so that deal fell through. It was unfortunate, very sad, because that deal would have potentially been a huge moneymaker. But you live and you move on to the next deal. So I still knew that I wanted to do a duplex, something of at least 2 units, but this time I had a different mindset. I said, instead of putting down 25% on a very expensive property, how about I get in with less money down, more leverage, maybe 3, 5, 10, 15%, whatever it is, and just call it a primary residence, and I'll be quote-unquote living there for 1 year, and then rent out the other unit when that year is up. Even though I would be in the negative every month because the rent from the other unit wouldn't be enough to cover the full mortgage, it still mathematically made sense to me because in total, after that year's worth of mortgage payments, you're still putting down less than had you put down 25%. So I tried my hardest to get pre-approved for a conventional loan to call this place a primary residence. Unfortunately, I couldn't get in with 5, not 10, not 15, not 20, not even 25. I had to put down 30% if I wanted to take out a conventional loan. And at that point, obviously, it would make more sense to put down 25% and get a different type of loan instead, a type of loan that I have not yet experimented with. So I could have put down 30%. It would have been a conventional loan, whether it would be Freddie Mac or Fannie Mae, but it would make more sense to put down 25%, use more leverage, and instead use a non-QM or non-qualified mortgage. And this one is a DSCR, or a debt service coverage ratio loan. In short, it's essentially a type of loan. It's a niche in between conventional and hard money. you're paying a higher interest rate, but the benefits of this type of loan is there's no income check and it's really asset and credit based. So they're really going to scrutinize your assets, whether you own one property or 100, and your credit as well. And that's what determines whether you get approved for this loan, not your income. They didn't even need to see bank statements or my tax returns to get approved for this type of loan. This is a very common loan for rental property owners. Not taboo at all for real estate investors. You are probably familiar with this loan and have used it yourself if you are a fellow real estate investor. Now, the only caveat with this loan, other than the higher interest rate, is that it can only be applied to properties having 1 through 4 units. You cannot use it for something 5 units and above. That's when you start getting into commercial property and you have to get a commercial loan. And of course, you always have the option of refinancing the deal later down the road. You could build up some equity, maybe interest rates will drop a little, and you can get in at a lower interest rate and hopefully lower your monthly payments down the road. What's most important though is that it's cash flowing right now. And if it works right now, the deal will also work and cash flow for you in the future. So that's most important. Don't try to force a deal. Don't bank on a property cash flowing in the future. Make sure the numbers work out right now. With these types of loans, the closing time is also somewhat expedited because your income and your tax returns and your profit and loss statements, your bank statements aren't going to be audited. So it's going to be a little bit faster than if you're getting a conventional loan through a credit union or something of that nature. For me, it was about 4 months. That included the holidays and some delays on the seller's end, so not terrible. It's important to know that you'll still need your cash reserves even though this loan is not conventional. So you may need to show 6 months to a year's worth of cash reserves in your bank account liquidated about a month before closing time. You'll also need to pay escrow in advance, so property taxes and your insurance, and in this case there's flood insurance and home insurance, all in advance. In addition, closing costs can be rather high with this type of loan. Even on a cheaper property, the closing costs could still be around the same figures. But one of the reasons they're so desired by investors is that unlike a conventional loan, you could have unlimited of these loans. You could have 1 to 10 to 100. There are no Fannie Mae or Freddie Mac guidelines and restrictions here that would mean a 4 or 10 loan maximum. You could have unlimited of these DSCR loans, these non-QMs. One of the most common misconceptions among early young investors is that W-2s and consistent pay stub income is absolutely incumbent to getting approved for a loan, and that is simply not the case. There are other options for you. There are other paths you can take, and definitely explore them. Talk to a mortgage broker, talk to other investors that are doing exactly what you want to do, and see what's out there for you. You can get creative with your financing, ask a ton of questions, learn as much information as possible. You can absolutely do it. We will analyze the numbers in greater detail in a separate video, and I'll provide you folks with some updates. But in this video, I just wanted to cover exactly what I did, the steps that I took to buy my second property. So I hope you enjoyed this video. I hope you got value out of it. If you did, give it a big thumbs up, smash that like button. I would appreciate that. And if you haven't already, make sure that you are subscribed to the channel. Click that big red button and have notifications turned on as well. And if you want to get some free stocks, all on me, all free, use the links down below in the description of this video. Sign up with the brokerage platforms, Robinhood and or Webull. You'll get some free stocks, some valued up to thousands of dollars in some cases. So let me know what stocks you do get. And if you want to connect with me on social media, I am on Instagram at Logan Cohn, LOGANKOHN, right there on your screen. Hope you enjoyed this one. I look forward to seeing you guys in the next video.